we're now in the second part of this exciting podcast with Veronica. Veronica Oswald with JP Jenkins is a director of really a capital market leader since 1991. So the first question, so we stress as exponential blueprint about intellectual property as a valuation driver. Tell me more about companies, the list where the IP was the key asset.
Indeed, Matteo, thank you for having me on again, and thank you for bearing with me. Obviously, the markets, from what we're seeing at the moment, are still not really moving that in that positive direction. So really, what we're looking at is helping companies to get the most out of what they've got. Very often, and London's been very famous for companies that do have a very heavy IP, where we can take them from that growth stage all the way to the listing and then help them with getting capital through that traditional capital market strategy. What we are currently seeing, that is not happening. The junior markets in London have not been performing, and that has been especially in the sector that is non-revenue generating, and that is very often a biotech, pharma, exploration businesses where you have wonderful ideas, great set of IP, but that is not being properly recognized. So just having that IP, yes, that is really exciting start, but there needs to be the further steps that will then start getting that delivery and that evaluation of the companies. When it comes to the IP, obviously it is important. It is important to make sure everything is properly safeguarded, registered. That involves a number of lawyers, which does become rather expensive. And this all happens typically at a point where a company is not generating a lot of revenue. So it is really important that the companies are able to showcase themselves in the best possible light to attract that investment. And that obviously becomes super paramount before you move into that commercial stage. Once that commercial stage starts being deployed, it is all about the team. And we always say it's great to have wonderful ideas, but unless you can execute them and start making them commercial, you don't really have a business. This is the really crucial part that I see a lot from the last 20 years. And from my experience, I've started in the capital markets, actually with an R&D listed company on the AIM market. And we had a wonderful IP, wonderful group of scientists that were extremely visionary. We had fantastic contracts with the large pharma companies, but we always struggled with that delivery because you typically were in the hands of these large pharma businesses and you weren't really driving the ship, so to say. So those 2 points are really important. It is really about trying to get that right support, but also having the right type of patient investor on your cap table that understands what the journey is, but also hitting those commercial milestones because at the end of the day, the investors come in because they do want to make a profit. It is often not a philanthropic exercise. So really having the IP, which is rightly protected, having the right kind of investors that understand this is not just a day flip. These need to be skilled, understanding, patient investors that will be supporting the company for potentially a long time. It takes quite a long time to get into that commercial element, but also having a way where you can help those existing or early stage shareholders that have supported you to give them a little bit of a way out if that is necessary, without trying to press the company to either an early stage exit, that would be an M&A, or perhaps even that listing of the company.
Thank you, Veronica. As we mentioned several times with the exponential blueprint, intellectual property is really the foundation to start really the wealth creation process. And according to several research, those companies who can actually declare what they own in terms of intellectual property, they tend to have 1,000% more chances of getting funded. This is according to European Union statistic as well.
Yes.
were saying before about the difference between the London name and the Nasdaq is obviously a difference of culture. Um, you need to protect and profit, effectively. So first you protect by creating the IP, and do not underestimate the importance of having a lawyer, because you can't just
Oh,
speak
yes.
to a customer. Just go ahead, Veronica. Tell me, what do you think about this setup? Yeah.
100%. And this is what I was talking about. The IP lawyers and the firms. This is quite an expensive exercise, but it is absolutely crucial to make sure that your IP is heavily protected. As soon as the information is widely available and you start showcasing what you can do, what your ideas are, you must make sure that that IP is protected and it belongs to you. And that goes, we now live in a global environment, and news is very easily spread from one country to another, all the way to a different continent. So it is really important to have that right support from the start. And it's important to really think about that whole continuation and the journey of the business to start really mapping out at which point do you engage the lawyers, at which point do you start getting your IP protected? How do you then move into the monetization part? Because all the way through this journey, you do need to have the right support. It is not just a light idea that just happens. It needs to be worked at, and we all know the founders work incredibly hard. But the important element that I often see that founders underestimate is really bringing the right talent to the team, because they might be fantastic at creating ideas, creating new product, new technology, but then having that technology deployed and then scaled is a completely different side of business. So really having the right protection and the right team of executing is super important.
No, thank you, Veronica. Effectively, yeah, this is where the high valuation triangle alignment comes into place, because we often said, yeah, that it comes step by step. And although in a startup phase, you have to really concentrate on intellectual property, then obviously you continue really the development and deployment of your intellectual property. When it comes to scaling up, you need really change the way in which you behave as a founder of the business, and then you need to really bring on board people. So IP, protect and profit, supply chain, but then succession planning. I
Yes.
we often use the example of football, where you need effectively three leaders. One is the selling, effectively the selling part of the business, because you have to sell what you produce. The second one is you have to produce what you sell. The third one, you need to generate cash flow. If we translate into sports team, should we say like this, you got an attacking player, an attacking leader, like a sales leader, a midfielder, like, operation, and then a defender, like, finance, who does more of the cash flow generation part of the business. So the founders have to become really the coaches, really. They need to bring in the right talent. And that's how you create confidence for investors. Tell me, Veronica, how do you see this happening in the marketplace? How do you see founders and businesses coming to you with the right recipe, or with a recipe that need to be instead redrawn or
Yes.
rewritten, shall we say? Yeah.
Yes, and let's be honest, as a founder, you're going to pivot. It's necessary to be able to remain dynamic. As I mentioned, the London junior market space has changed a lot over the last 15 years, and that support for pre-revenue businesses has been really difficult to drum up. We've been working with a number of biotech companies, a lot of very heavy R&D, where there is a lot of protections already in place, but what the businesses haven't been able to do is actually deliver the commercial model. And this is why going out to the market too early is also obviously not the right strategy. It is important to get some money and some power into the team to be able to get the ideas rolled out, but it can often come at a price. So really making sure that you've got the right people in place, having the right protections, but also having that really clear path to how that is going to become commercial is very crucial at this point. Just going to the market with a small valuation and then praying and hoping for the best is going to heavily backfire. So having perhaps a venue that would be a little bit, I don't want to say forgiving, but would be more patient, is often a little bit more helpful, let's say, for the founders or for the businesses. The way secondary markets and the way JP Jenkins actually operates is providing a safe space where share prices are not volatile. What that means is that share price is typically fairly static initially until the company starts going into that deployment, that commercial area. But what that allows the founders to do is to start building the foundation. I'm an engineer by trade, and I always look at it from a slightly different view. I believe, having the right foundations and then building on top of it is the most logical way to do things. You don't want to be starting to sell a product where you don't actually have the team to be able to deliver it, not to mention have it protected. So really starting from kind of the very natural, logical way where you have the right foundations and then building on top of it is the right way to approach it. Yes, it may take a little bit longer, but you're doing it in a safe, sustainable way where you're positioning yourself for a success rather than for a failure. And we often see all these crazy stories where you say, oh, fake it till you make it. Yes, that may work in some instances, but not in the technology space where you really need to have your ducks in a row and you have to be sure that what you're selling and what you have can also be delivered.
Thank you for reinforcing this point, Veronica. And in fact, it's about really comparing what we normally see. We normally see businesses hustling for revenue, when in fact what create valuation is positioning and structure. Right. So those two things really, really matter for investor. And obviously, after we see the first few angle of the valuation triangle, intellectual property monetization, and then succession planning, what else can a business do to become much more investable? And so
it's going to sound so simple, Matteo, and I say this times and times again. It's under promise, over deliver. It is very basic. What investors want to see is you want to build a trust with them. You want to tell them, okay, I have a 2-year plan where I am going to make sure all my IP is protected in the next 6 to 8 months. I'm going to take these steps to achieve that. You raise some capital, seed capital. You can also look at different types of grant funding. You go and deliver at that step. You obviously have your journey mapped out and how you're going to also roll out the product, but it's all about the communication where, yes, you have now completed your step, your IP is protected. In the meantime, you're also speaking to some commercial partners, you're speaking to a new team that can deploy that product as well, and you bring people at the right time to the table at the right stage. And it's all about communication. What is the worst thing that we often see, and that is typically quite a lot of cases also in the EIS sector where we've seen there's been fantastic deployment of capital. There's been £32 billion worth of capital that's been deployed to really innovative businesses. But what they often fail in doing so is really communicating with their shareholder base and telling them, look, we have taken the money. This is what we have achieved. Now it's time for us to move into the next phase and the next stage. And that's when they start asking for more money. The worst things that companies and founders can do is take money, keep everyone in the dark, and then go back in 12 months time to say, oh, we've burned through all the cash. Now we need more. Thank you very much. It's absolutely the wrong way to do that. It is really necessary to make sure that you have the communication channels and be able to showcase how you're delivering the steps that you have promised. It kind of seems overly simple, but it is all about taking the right steps. Trying to put yourself in the shoes of investor. What would they like to see? And making sure that you deliver on those steps. And look, we all know markets move really quickly. Things change, things pivot. If that is the case, yes, communicate that early before there is a fire. Make sure that the investors are aware you're perhaps facing certain challenges. Very often, it's very much worthwhile to tap into your investor base as well, because very often you've got angel investors and you've got investors that invest into this space because they already are familiar with it. So they may have an idea of how they can help you. So it's really trying to utilize all the different elements and all the different tools that you already own and have, rather than trying to resolve often all of the problems just on a hop and trying to think of a very quick solution. Always look at the long-term solution. What is going to get the company to that growth stage? What are those missing parts? What are those elements? Where can you find them? And don't be scared to ask. It's necessary to work as a team and to really bring the right expertise to the table.
We often mention about the investor relation part of the business, where the confidence usually comes from financial intelligence, because obviously the investor, at the end of the day, they would like to see a return on their investment. That's the reason why they invest in the first place. So that's where we often say, well, CFOs are absolutely fundamental. I've actually seen a situation where investment agreements dictate that the business has to have the right caliber CFO in place. So yeah, you can tell me more about this as well, Veronica. Yeah,
it is, Matteo, and this is where often founders and companies get very attached to the people that were very much at the beginning of their journey. But as their needs, the company needs evolve, you do need to often rotate the people. Yes, loyalty is extremely important, and you always want to surround yourself with the right people, but you need the right skill set. And often when you start getting into a position where the business is starting to generate more money and it's actually moving into that third element of succession and looking at the cross-border situations, it's a very different ball game, and it's a really different skill set. So having the right C-suite executives is extremely important. Perhaps a CFO that is very much used to just a little bit of a fractional part-time job where they come in once a month and just look at the books and say, oh, you're doing well, really evolves into a role where you need a CFO that understands how to look for efficiencies. Where can you improve? Where can you maybe scale back? How do you really get into that next stage? Is M&A perhaps the right type of strategy which you can deploy and grow a lot faster? And a good CFO will be able to guide that team and the founder to the right position. It becomes proactive role. So it really changes from that reactive role where you go and ask your CFO that you're pretty much using as an accountant to do the books, to really become more involved in that strategy level. It's, again, different skill set. And very often I feel founders, they have a lot of loyalties. They feel almost scared to really move into that next phase of succession and really bring the right people on board.
Obviously, each business is unique, but normally, I mean, in most cases, you need a CFO who understands really well the wealth creation process. That's where we see really the best CFO performing.
Yes.
And don't forget, if you don't choose your own the right CFO early enough, you might be in a situation where the investors will actually select which CFO you should use, which is not a great position to be in.
No, you never want to be put in the corner that your business is not performing and your investors actually push you to hire a CFO. You want to make sure you're aligned and you've got enough lead time to plan these things. But having the discussion with shareholders, and when we talk about investor relations and investor relation program, it sounds really scary, but really what we mean by that, it is just a communication element where you are able to connect with your shareholders, whether that is a quarterly or 6-monthly update where you tell everyone, but truly tell everyone how are things developing, which areas are succeeding, which areas need still more time and attention. And you really seek a closer relationship at that starting point of the journey is really important.
Yeah, thank you for reaffirming that. And as we're talking about this triangle, so the first triangle, we're talking about intellectual property and then succession planning. Now, as I was asking, what else can a business do after doing these two things successfully to increase the valuation? And the answer is going global. And what we see with the major household names, the way they do it, usually the globalization of the business, going from local to global, happens by going back to step one, which is intellectual property. Now, usually we see the example of the American businesses, for example, like, the big one, Apple, Microsoft, Gillette, all these businesses eventually in some sort of shape or form, they tend to go back to intellectual property as a way to become global. Example, Gillette would do a distribution agreement to sell more blades into a new market. Coca-Cola will do more deals with more bottling plants. Does not necessarily create new industrial infrastructure in another country, but you leverage out of your intellectual property, out of your positioning, and out of your structure. How do you see this happening with your clients, Veronica?
We do. I have to say, majority of our clients are still UK based. We're getting more exposure in a pan-European space at the moment, and to be honest, it's very much the same case for JP Jenkins as an entity. Whilst we have been around for a very long time and actually predate the traditional junior markets, we have been taken over. We've got a new team, new strategy, technology has been enabled and deployed into what we do. And we also look at it just like any other company and look at our own strategy. You always want to make sure that your position in your local market is very solid before you start embarking on the international, I don't want to call it a goose chase, but an international expansion, because very often what we see is companies think, oh, we're going to get much better valuation in the US, let's just jump over there. And you do not have any infrastructure. And what that becomes is a real distraction where you burn through your bridges because you're not putting enough attention into your local market, but you're now looking at this big shiny thing in America. And that is ultimately, again, going to crash and burn. So really looking at those foundations, making sure foundations are solid before you take that next step. Yes, having the right protections in place, having the right market research, extremely, extremely important before you start looking at that international expansion, but making sure that you do have the right footprint. We work with a wonderful EV charging business that is doing extremely well in UK. They've got the right protection. They would now like to look at international element. And they're doing it the right way. They've got all the protection. They have a well-oiled machine here in UK, fantastic contracts in place, full team to support the delivery of those. And now they can look at the international element. So it is really taking those right steps and then having the right financial support from the investors is really important, because they have been able to deliver on their local promises. Now they can take the next step. Very often you will have companies that would like to start looking at different areas and different jurisdictions, but they haven't been able to deliver in their home market. So it's really important to make sure that your financials, your team, your commercial element is working really well before you start looking at the international element. But absolutely now, as I say, we live in a global market. It is not difficult to start deploying into different regions. Have a look. Research always comes at a premium. That is your best friend. Try and do your research before you start spending a lot of investors' money onto the international expansion. But don't forget about your home country and your business where it really started, because that needs to work extremely well before investors overseas will start looking at it.
Each business is unique, as we know. But for example, we see situations every now and then. For example, in the fashion industry, I always mention Zara, because Zara has got such a powerful supply chain strategy, where they reach the consumer so much more quickly than their competitors. So
Yes.
yeah, don't forget about founders. Don't forget about really the supply chain. So when you develop your intellectual property, you keep investing in it, you keep developing it in such a way that you are in a commanding position also with your competitors. Zara, for example, reaches the consumer from concept to a Manhattan store in New York in just 21 days, while the competition does it in 6 months. So
Yes.
that's an amazing
USP. Yes,
unique selling point. Yeah.
it is. It is. And it's so important to recognize where do you fit. What is that proposition? What do you have that does better? Or if there is a gap in the market and there isn't a business that is doing what you do. Remember, people are very nimble, and small companies will be able to move very quickly. So having the right infrastructure in that local market to be able to successfully deploy is very important. But I always say it is really about the right investor support. Make sure that you're well funded, that you don't run out of cash halfway through the deployment. Make sure that the investors that are coming in understand exactly where you want to position, and to make sure that they're well informed and they can stay with you throughout that journey. If they do need to take some money off the table, to provide them the way of doing that in a safe environment where your share price doesn't get damaged. Just really think about all those points that the investors themselves are going to go through. As you move into that international expansion, you will probably need a different type of a support, and that may really start with an institution. So really having the right process in place is crucial, but having that right investor on board is even more important, because you will need them, and you will need to make sure that you can get the right support, and perhaps not just use the resources from the local country. Of course, if you can, that's fantastic, because you don't dilute as much. But if you do need external support and the right investors on board, make sure you position yourself in the best possible way for them to enter, and to make sure they support you through the journey.
Thank you so much, Veronica, for giving us your overview about how the high valuation triangle aligns with the investor mindset effectively. And that leads me nicely to the next part of this podcast, which is about readiness of founders and growth. And the first question I wanted to ask you, generally speaking, what kind of founder, or the typical company that you think is best suited for a private listing with you with JP Jenkins?
Yes, typically we see companies at various stages, Matteo, and that really depends on what journey they are looking at, and which direction they would like to really embark on. And you've got different businesses. Some of them have been supported through an EIS shareholder. Some of them have really started from scratch, and the founder is still pretty much the only shareholders. But what they need to start thinking about is how are they going to get that external support, and where do they want to move. So typically we see companies that have been around for 3 to 5 years, so not a complete startups. They have already gone through a lot of pain and a lot of growth at that point, and they really are now looking to see how can they develop further. Then you've got serial founders that have done this times and times again. They have learned through the battlefield, and they understand some of the challenges. They think, okay, well, I am the founder. I'm going to need to get some extra support. I am going to start looking at ultra high net worth investors. How do I attract them? What do I need to do to bring them to the table? And how do I get my product out there in the most efficient way? So it really does vary, but typically we see companies that have been in operation and are revenue generating, unless they are in an R&D space, for a number of years, a couple of years at least. But yes, that the team is always the most important thing that we look at when we do our own due diligence, because serial founders and founders that have experience from their industry or from the sector are the ones that typically will succeed. having a clean history, super important, and having the right team behind them to be able to deliver. So having those key functions filled is really important. When it comes to a monetary side, we don't look hugely at the valuation at the beginning. What we really look at is how well the business is funded, where does it sit. If we are going to start helping the business to be promoted to further investors, we obviously need to make sure that there is enough funding for them to sustain the next, let's say, 12 months of operation. So really, we've got businesses that range all the way from £1 million to 350 to £500 million. So it is quite a great scope, all different sectors, different stages, which is very interesting because we can really see how this strategy can be deployed for companies that are just £1 million in valuation all the way up to £500 million worth of valuation. So it's really about the mentality of the founders and the teams. How are they going to look after their investors? How are they going to attract new investors? And how are they going to map out that journey of really either the full exit, or if they just want to make sure that they're going to continue growing, but they want to make sure that the investors that have perhaps reached the point where they no longer want to remain have a way out.
Oh, thank you very much, Veronica. So effectively, you look also at the feasibility for a company to have shares that eventually can be traded.
Right.
Yeah, no, thank you for mentioning about the team. You know, the team is so important. You know, we're talking about succession planning. Sometimes it's difficult to explain what succession plan should look like. Yeah, but yeah, it's about really as we were saying before, the structure as well as the positioning. And I presume you see so many mistakes that founders make when they start to prepare for liquidity. Just tell me, which one do you see the most happening? We know that each institution is unique, so it's difficult to sort of generalize, you know. But how can they avoid this type of typical mistakes that
Yes. I would say from experience, the majority, I wouldn't even call them mistakes, but perhaps just prioritizing is the way to look at it, where companies don't communicate enough with their investors, which means that the investors get tired, they get fatigued, and they feel like, well, the company's not really doing anything. The share price is static. No news is coming out. They clearly have reached, I don't want to call it the top, but there is no further way to go. So it's really just making sure that everyone is aligned to what the business is looking to achieve. The second challenge, and I again perhaps calling it a mistake, is venturing out to different markets too early, where you don't have the infrastructure in your home country fully solidified. Other thing, overspending. We see this time and time again where companies do raise capital and they now want to showcase to their investors, okay, we have now hired 50 people and the revenues just stagnate and really stay where they were, but the company is now burning through a significant amount of cash, and that just means that they're going to need to go back to their investors and they're going to need to raise more capital, but they haven't really achieved their deliverables. I think from just the top of my mind, that is obviously kind of the usual type of things that companies perhaps underestimate. Time really does fly. I think we can all feel it. The time goes quickly, so being able to move, but having the right infrastructure behind you is very important. So even if you do raise that capital, you don't want to be taking 6 months just to hire the right people to start deploying. So it's being extremely organized is very important. And if you as a founder are not extremely organized, make sure you have someone that is going to be sitting and holding your hand next to you through that journey to make sure that you have all of the right pieces in place so you can do and utilize your skills to the best of the commercial ability, really.
Yeah, I often say that generating cash flow is the ultimate, should be the ultimate objective of the business.
Oh, yes.
Obviously, without without uh, neglecting what needs to happen so that the business has a high valuation. So selling, producing, generating cash flow. Because if you do not generate cash flow, unfortunately, there are really difficult situations that they should be avoided. But generally speaking, generating cash flow is the ultimate objective, the long-term objective for any business, really. So
It is,
yeah,
and
thank
it's
you
the
for.
easiest way to quantify how you're growing. It's again, put yourself in the shoes of investor. The first thing that they're going to look at is, oh no, what market penetration have you achieved, or which new areas have you deployed? But unless you're actually generating commercial element out of it, well, it's very difficult to quantify. You can talk about the size of the market, but unless there is that delivery of that commercial element, it often doesn't mean much.
Thank you. Thank you for that, Veronica. Just a question about the size. We're talking about
Mhm.
potentially SME doing $1 to $5 million in revenue. Now, is it realistic to go to a private listing? Now, I know that each business is different because you might have infrastructure that may need years.
Sure.
Is it mainly for larger scale-ups normally?
Typically, no, companies that are generating $1 to $5 million in terms of revenue is an excellent start. We often see companies that are not generating any revenue, but have had a number of capital raises and now have a very large cap table. And in those instances, we say, yes, you absolutely should have a trading facility for your existing shareholders, but make sure you really we don't run their businesses. All we can do is provide the infrastructure to trade the shares, but having that revenue is extremely important. And having $1 to $5 million revenue, of course, that is really, we look at different factors. Revenues is one of them, but it's really absolutely suitable. What I wouldn't suggest, and again, depends on the sector, how you value your business, looking at the public markets and raising money through those structures might be too early. So having a listing or having a visibility through a trading venue, yes, is absolutely a good step. Obviously, I will be biased, but perhaps looking at the traditional capital markets where you lose control of who's coming in and out of your cap table, and share price operates on a traditional supply and demand is too early, in my personal opinion.
Thank you for giving us your views, Veronica. And yeah, it's very important for those who are listening to understand what is the best way forward and what's the best possible situation in which to act. And now coming to the next part, yeah, we want to hear about your
Mhm.
success story, your case studies. Share an example where you've really transformed the business. I mean, not necessarily with the operational side, but
I
thanks
was
to
going
the
to
JP
say we'd love
Jenkins
to take the
platform.
credit,
So
but
how did your platform help so much a business to say, wow, this is the shareholder liquidity, it became an engine for growth, really.
that's a really nice way of describing it, Matteo. It is, as I say, we don't take the credit for the founders and the team's hard work, but what we really love to be is really part of their growth and how they develop, how they get to either a full exit or they just remain private. But we're now working in a nice close relationship where we can service their existing shareholders and help them recycle that capital through the new investors. We've got companies that have come off the traditional junior stock markets and they arrive to us at a really depressed price, just because they're coming and becoming private and coming off the exchange. And this really just highlights how inefficient sometimes these junior markets can be, because as soon as the company would have put out an announcement and said, okay, they're becoming a private, the market makers would naturally start pricing the stock down, at which point they do arrive to us at a slightly bruised stage, let's call it that. Whether that is really the whole experience when working with a city or looking at their share price, but we've had a number of companies that have joined our venue and have really succeeded in terms of how they approach it. They remain active, they communicate with the shareholders, the liquidity starts flowing, the company starts getting back into the positive EBITDA, starts really focusing on what is their core business focus. And that actually happened a number of times already this year with a lot of the businesses that have joined us. And we've got some really large names, to mention a few. And they haven't had the best experience in the public markets for various reasons. But as soon as they come off the market, they can really get back to basics, start looking at the business, start restructuring, start looking at where they can bring the efficiencies. And that tends to start reflecting in the share price accordingly as well. You don't have to operate like a traditional stock exchange. Stock can be repriced according to a transaction, whether that is a capital raise or an independent valuation. So it can really be brought back to close to that net asset value that the businesses have, and really start moving into those right multiples of where the business should be. And so it is a nice and efficient way. I have to say, unfortunately, we haven't had any IPOs in the recent times. Again, looking at the macro situation, hopefully that will improve, because really we do want to support the markets and we do want companies to actually go to a full listing. But we've seen a number of acquisition from the venue where companies have actually been acquired, and investors have achieved full exit and done really nicely out of that. So that's been lovely to watch as well. We've got a number of businesses that are now using M&A type of a activity, where instead of just looking at their own balance sheet and own infrastructure, they start acquiring different businesses, which means that the share price is increasing. More eyes, more investors, more people are drawn to that story, and they grow really successfully relatively quickly as well. So some really lovely stories out there.
Oh, thank you so much. Obviously, we'll spread more about after this podcast about this story, because we want to learn from the story. And we were talking earlier on about the mistakes, but obviously, let's talk about also sometimes, we learn a lot from failure as well. Companies that struggle to benefit, what sort of lesson can we tell smaller founder they should be learning from potentially from more than potentially, say, from struggles that we've seen happening. Obviously there are always situations where that there is something to learn.
Yes, I think we often see that we learn from our own mistakes probably the most. But yes, if you can try and learn from other people's mistakes, highly advisable. Of course, that's not always the case, and things do happen. We see that quite often with companies that are, again, in the R&D space, where they have raised capital but haven't been able to monetize their products or their technology, where they have really failed. And that's not because, very often it's different reasons. It's not always the founders that have failed as such, but they haven't been able to raise capital, which means they're not able to continue protecting their IP, continue paying their staff, and that obviously becomes catastrophic for the business, where it then goes into liquidation. Various reasons, various things that can happen going wrong. So I say always watch out for those traditional ones about venturing into new areas too early, not having enough research on where you are looking to deploy, or overspending, going a little bit crazy with hiring a lot of staff. We see that quite frequently as well. And then obviously having to backtrack gives you also a reputation. The worst thing, again, over promising, under delivering until a point where the investors are fatigued and new investors are no longer interested to take a position in the business. So having a very direct approach, but very realistic view is very important. So definitely some of those traditional things to look out for.
Thank you for giving us also this window about what sometimes needs to be done better, because that's where we learn so much from those situations. And yeah, obviously, yeah, we've been speaking about positioning a lot. We've been talking about structure. And I think, yeah, that now should resonate with so many of our listener. This will bring me to to actually discussing about the future of private markets, really.
Yes.
Yeah, because obviously, yeah, we've gone through quite significant periods over the last, let's say, 2 decades, really. Uh,
Indeed.
Private capital markets, according to some research, including private equity, they're actually so large that many people don't understand how large they are. Actually, they are estimated at $13 trillion, and according to research, in the next 5 years, 5 to 6 years, they've actually got the potential to reach $23 trillion. So,
It
uh,
is significant. Very
so private
significant.
capital markets are outpacing public ones, yeah. So you just tell me in your crystal ball, what do you
Oh,
think?
I wish Matteo, I wish I had one, but yeah, I mean, let's just look at the hard facts. Companies are typically growing at a faster rate in terms of share prices while they private. Private equity models are often very aggressive, but they really do look at the numbers and where they can scale in terms of efficiencies and really bring things together. So whilst it may sound quite aggressive, they do have a very structured view on what they look at. The private markets are only going to grow. There is huge amounts of capital that can be deployed, but it will be deployed into businesses that do really well and that showcase themselves. If you are not visible out there, you are not able to tell your story, you're not able to bring that attention, then you are very much hidden from a lot of that exposure. But the private markets are here to stay. And that is not just from what we're reading in the news, but it's also obviously acknowledged by the regulators here in the UK. FCA and HMT have just brought in new legislation that actually covers the private markets, which is quite interesting because, as you've seen, JP Jenkins has been operating since 91 in various shapes and forms. But at last, the private markets are now going to be taken seriously, even by the regulators, which can be a good thing, can be a bad thing. As we know, regulators in UK very often over-regulate rather than just regulate accordingly. But there is a lot of emphasis and a lot of lights, green lights really coming out from the institutions and the government, where we're trying to stimulate the businesses and where we're trying to stimulate the economy. The new Pisces framework is being launched, and the Pisces framework really covers SMEs and private companies that have never been listed but would like to provide a trading facility for their existing shareholders. So we're still talking about a secondary market as such. This is not a place where you go and raise capital. This is where your existing shareholders are able to sell shares and exchange them for the new investors that will be supporting the business, as we were mentioning throughout the podcast. Really, the aim of the regulation and the government is stimulate the economy and stimulate the number of activities that are happening in the space right now. So it is a positive change. There are some very exciting tax elements that will be attached to the Pisces. We just had London Stock Exchange, of course, that had their first license issued. JP Jenkins has obviously applied for a license as well. So we're hoping that is going to arrive and will be issued with us shortly. And it's really about how the institutions are going to embrace the new framework, because it really is aimed, and that is at that institutional level of investment rather than the traditional retail. We will watch and see how that will pan out, but we're excited because it brings a lot of light onto what is really happening out there. And as you said, there is a huge amount of dry powder that is available and able to be deployed into the right businesses. And it's about finding those right businesses, making sure that those companies and businesses are able to showcase what they're doing, but also showcase how they're delivering on those promises.
It's exciting to see how platforms like JP Jenkins can actually gain ground compared to traditional exchanges. So it's about really education, and yeah, this is really the wish, that we have, so that we can open up, because we tend to see top and bottom of the market really. There's a lot of excitement about, obviously, the publicly listed company. Everyone knows about them, and the startup who are not investable sometimes, most of
Yes.
the time. But in the middle, we go really the real economy. Some
Yeah.
people, they call it Main Street as opposed to Wall Street. But what we tend to see is what actually numbers tell us, and they will keep telling us, because this is not really something that we can change. Statistically speaking, the more than 90% of the businesses that effectively they provide more than 80-90% of the jobs to everyone in the world, really. There's not really enough visibility about them.
Yes.
And ideally, your platform obviously can take all the business in the world, but it's really the right setup for many businesses. Yeah.
It is. It is. Again, it's almost like a supermarket approach in a way, where yes, you have some businesses that are early stage with very small cap table, and you've got some very large businesses with perhaps a really small cap table. It's about how you're able to showcase yourself and tell people, look, I'm here. This is what we're doing, and this is how we're doing it. Would you like to join us on this exciting pathway? Would you like to help us in certain way? It's quite interesting how in various ways it can be approached, but that visibility is crucial.
Okay. And if you had to provide just one piece of advice for the founders who are listening, who want to scale, they want to be more visible, they want to increase the valuation, prepare for investor, what would it be?
Mm. I would go back to what I actually mentioned earlier today: under promise, over deliver, but have a way of actually being able to communicate it out there. Because if you are over delivering and under promising and no one knows about it, then that's also no good.
Okay. Well, that was very, very, very direct. Thank you very much.
A little bit too
Matteo.
direct sometimes, but as a founders, I think we'll find you haven't got a huge amount of time on your hands. There is 5 million things you've got to do, and you've got to prioritize on what is important and how you're going to get your business out there and get it off the ground. So I completely sympathize. Being in the same shoes, it is a lot of hard work, but if you can make certain things easier for yourself, do it.
Okay. Thank you for this. Thank you for this advice. Very, very simple, but absolutely necessary. Necessary, absolutely.
Thank you,
So,
Matt.
final consideration, Veronica, tell us about yourself, how to reach you, how can people benefit from JP Jenkins? How can they get in touch with you?
Of course, Matteo. Yes, everyone can reach me through JP Jenkins. My information is actually very publicly available. I am on LinkedIn or directly through JP Jenkins. Maybe we can put a little email address link there as well, which is vo@jpjenkins.com. But do all go and have a look at the JP Jenkins website. So it's jpjenkins.com. You will find all of our information. We're quite active on the social media venues and platforms as well, to make sure we give plenty of visibility to our clients. But yes, feel free to contact me directly, either through any of those channels or through an email, or give us a call.
Thank you very much, Veronica. And as we frequently said, this was a really fantastic podcast with so many insightful advice and situation from Veronica. Don't forget about subscribing to the YouTube channels you're watching, and also to subscribe to our newsletter, The Exponential Blueprint. You can reach us every Wednesday. It's now trusted by more than 22,000 founders and executives. And our YouTube channel has got more than 40,000 subscribers. So it'd be great to have you, and it will be great really to have your comments, your views on all of this. And we'll be covering extensively about JP Jenkins in the next few editions of the Exponential Blueprint, where we'll be talking more and more about how private markets can really help shaping up a successful economy and a successful business for you. So thank you very much, Veronica, for today, and no doubt we'll continue to be in touch with the further episode.
Thank you, Matteo, and thank you everyone for listening.
Thank you. Bye.